Oh, I apologize. I'm not sure what happened, but we lost connection. And I think I was just talking about the test. I started a new one so that we still have the chat. The old one, if I continued on the old feed, I would lose the chat. Any kind of interruption affects the chat. So I'll wait for people to come in. Sorry. So as I was saying, I extend the deadline for assignment 2 to Sunday at 11:59 p.m. and I will send an email about it. Okay. And I was talking about using Excel. The assignment should be handwritten, but if you use Excel for some parts, be certain to include formula. Okay, so put formulas in the headings, or I don't know. You have to somehow express the formula. Show me the formula you're using in each column. All right? I'll be right back. I'm gonna wait. Let's wait a few minutes for other people. All right, how many do we have? 10 people? Let me see. Okay. Good afternoon, everyone. So, for this assignment, I said I'd like you to handwrite the assignment, and if you use Excel, to include the formulas that you use for Excel. Otherwise, it will be difficult for me to tell what you did if you made a mistake. And and make sure you express them, in writing in columns. And Anybody who's just coming in, I extended the deadline for the assignment to Sunday night. I also talked with the administrators and the dean, and the last test or assignment will actually be a test. It will be for 2 hours, and it will be in the building. What they are planning to do is separate students into 3 rooms to write the test. And the test will take, like I say, it'll be a 2-hour test. It will be on all of the topics, a little bit of everything. Okay? So that will be for the final test, the final week. I will give you another test, another assignment this week for this week. And then there will be a test on, we talked about Sunday, the last day of class. To administer the 2-hour test. So that would be May 9. I can see it will either be May 9 or May 16. I need to confirm if you get a week. So I will confirm that. So assignment 4 will be a test in the classroom on a Sunday, and I have to be sure if it's May 9 or May 16. I have to find out. Okay, so any questions about the material we've talked about so far? Are you staring at a blank screen? Let's see. Okay. So this is an example to illustrate this discussion that we had regarding the relationship between real rate of interest, inflation, and the nominal rate of interest. Now, usually until this point where I mentioned anything about real rate, we worked with the nominal rate, already incorporating the inflation rate, the growth rate effect of inflation on the real rate. The real rate is that rate determined by supply and demand in the capital markets. We know it as the cost of borrowing. Now this incorporates the inflation, the fact that prices are rising over time. And that if you have a level or indexed income, you have to be careful and adjust them. Sorry, if you have an income that's fixed, you need to index them and adjust them for inflation to make sure you have the same purchasing power from time to time. So we did an exercise using inflation, and this is just one more, okay? So here I show you that at time 0, you have $2 million. Wouldn't that be nice? And in financial markets, the nominal interest rate is 4% without inflation. However, there is inflation in the housing market. The nominal rate of interest in the housing market is 4%, let's say. And the prices, the price of houses or homes is rising by 5% per year. Look at that. So how does that affect decision making? Well, these are different sectors. The financial sector, the housing market sector, they're related, but we'll think of them as distinct because there's no inflation in the financial markets right now. So what does this mean? If you're looking at buying a home and you're not sure if you found the right home or you're not sure whether to buy now, keep in mind that if you don't buy, your money will grow in your savings account at 4%, any kind of, or in other invest. If this is the only rate that's available to you, it will grow at 4% return, whether you if you access financial markets. But if you buy a house, look how much you will have in value. You might not sell the house, but this is the market value of a home in Beverly Hills now. Because right now, a house in Beverly Hills is worth $2 million. So to retain the purchasing power of a home from one year to the next, it's arguable that you should buy the home, and then as the prices go up, you'll still be able to buy a home in 1 year by selling yours and buying another one. So what's happened? The real value of money has depreciated if you're interested in purchasing a home. If you just leave it aside and don't buy the home. So these are the equations that we discussed, the Fisher relation, and with that, I'm going to use that relationship to reveal what is the real rate of borrowing lending. It turns out the real rate where financial markets have a 4% rate of return equivalent. Well, this is also the case in the housing market. So because there's inflation in the housing market, the real rate is a negative. This reflects the eroding effect of time, the effect it has on purchasing power. So what does this do to our cash flows? Remember this expression for the relationship between cash flows. Notice that over 1 year, $2 million in the housing market, $2 million property will become $2,100,000 property. So using the rule that nominal cash flow should be discounted with the nominal rate, this is the net present value using nominal dollars, and the nominal rate, this is the net present value of buying a home now. So this is telling you to buy. Similarly, if I use the real rate, I have to use the real dollars with the real rate. So these are the real dollars. Now look what happened. Now this probably was fine. The value of the house now, the value of the house next period in nominal dollars. In real dollars, a house is a house from time 0 to time 1. To be able to buy the same house, you'd still need an amount So this 2,000 represents the real dollars. It reflects the purchasing power. The purchasing power of what? Well, relative to year one, a house. So you should be thinking of this as a home or a house in Beverly Hills. You know, Beverly Hills, California, where the movie stars in Hollywood live, or some of them. And this is also this is the price, or this is the real value, or the real cash dollar amount of a home at year one. But you have to use the real rate. The real rate was negative, so you see, it tells you the same story. Buy. If you are in the market for a house, you should buy a house now, as opposed to leaving it in financial markets, leaving your $2 million in financial markets. Uh-oh. Did you not see that? I was writing, but it didn't show up. Why? Did the connection break? Connection keeps breaking. I don't know. I have to say what I said again. I'm having a bad time. Did I lose you again? I gotta check. I did, Jeffson. I was writing down, but you didn't get to see it. The connection broke. So, as I was saying, and I guess you didn't see it, I don't know if I should, what I should do. This connection is so bad. I'm not sure why. Oh, so bad. Okay, well, I was writing. I didn't look up. Okay, let's see if I can do this again. If I get cut off again, I'm going to have to go into another room. It might just be in the location I am having trouble. All right, so what I was saying is that, and I was writing, but it didn't appear. So let me see how much of it you saw. No, you didn't see anything I was saying. I'm just looking back at the video. All right, so what I was saying in repetition is that financial markets, the nominal rate is 4% with no inflation in this example. Right now, you have $2 million. So the options are invest in financial markets or save in financial markets at 4%, or turn to the housing market. What's happening in the housing market? Well, if you're in the market for a home, there's inflation in the housing market, so it would be smart to invest in the housing market now, because what will happen is if you don't buy now, your money might grow to $2,080,000, but you will be short to buy a house in the Beverly Hills, California, because by next year, a house in Beverly Hills will be worth, well, you have to inflate it from $2 million to $2,100,000. So it appears that the real value of your money has depreciated if you're interested in buying a home. So you should be really quick about buying something before the prices go up. And prices in the housing market, I mean, they just have not gone down as they should lately. And that's a problem. So just to recap some of the formula that we learned about the Fisher relationship. And so what I can do in the housing market is find out what is the real rate of interest. And it looks like I'm just going to stop a second because there Pierre wrote a comment. I am not sure. You guys will have to talk about that with the administrators. It is just for 2 hours on a Sunday. So the class will continue distance, but the test will be on a Sunday for 2 hours. So I will have them talk to you about it and find the right date. Okay? Okay, so if you work this out, make this calculation, this reflects what's happening, a loss in purchasing power over time. What happens with the cash flows? Let's look at this formula for the cash flows, remembering that one period passes with inflation of 5%, and it's apparent that in nominal cash flows, you'll need $2,100,000 to afford a house in 1 year. So, what to do? We can check the decision. We already know the right decision is to invest in the house to retain our purchasing power, but I want to show you here that you could figure this out using the approach of discounting nominal dollars with the nominal rate, and you'll see that in nominal dollars, to buy a home, if you buy a home now, the $2 million home will be worth $2,100,000, which you discount and put into the NPV formula. And it shows that this is the value, right? This is your dollar return to buying a home. It's positive, so you should buy. You can do the same thing with the real rate and the real dollars. Just note that in real dollars, it's $2 million that you write here using the real rate, which is the negative rate, and you get the same result. Okay, so this is a point that I made. Real dollars with the real rate, nominal dollars with the nominal rate. And that's just another example showing you that. Okay. So I discussed all of this material last class. This is just an example showing you the effect of the tax savings as a result of deducting from taxable income the depreciation amount. And then this is the exercise that we did together. And then I gave you some exercises. I gave you some homework. I gave you one exercise and some other exercises to review the old material. What I did at the end here, we talked about preparing a spreadsheet with all the information and calculating the total project cash flows. And then what I did in the UAir case, in the questions, I asked that you analyze it in the presence of inflation. I prepared the cash flows rather than nominal. I prepared them as real cash flows and then asked you to verify the same result. But we did not include the present value of tax shields here. We did those separately. We consider tax shields a stream of nominal cash flows, so we calculate those with the nominal rate. You should get the same answer. So whether you use real cash flows with real dollars or nominal cash flows with nominal dollars, you should get the same rate. The same result. Okay, so no questions for me about your assignment. I want to see if there's any questions about any of the handouts I gave you. I gave you several handouts. I gave you this one. Did I give you 3? I gave you 20.5, 21.5, and 22.5, I guess. So no questions? No comments? I did give you the answers, Franz said. I gave you all the answers. You have all the answers. These are all the steps. I can do another one, but it's just a matter of reading through them. You have all the answers. You have to read the case. You have to find the elements. You have to work with income, investment, income separate from investment, separate from the tax shields. So you have all the steps, Franz said. We can do this one together if that helps. But you need to tell me which one you want me to do, because I'm just going to pick one and I don't know if that's really the best one that you need. So this is document 21.5. So what we have to do is we have to see which parts of this are income, investment, and tax shield. So I'm going to read. As a newly hired financial manager of the Espresso Roast Corporation, you are considering the following investment to produce specialty roasting equipment for the next 4 years. The required investment in machinery is $40,000. So what is this? Is this investment? Income? This 40,000, sorry, where does it go? Income, investment, or tax shield? It's an investment, right? And then after 4 years, so I'm going to underline that. Four years is the project. The machinery can be sold for $12,000. Where does that amount go? Does it go in income, investment, or tax shield? Okay. You think that's income? That will be part of investment. Okay, that will be part of investment as well. So what I'll do is, let me do this in colors. Maybe I'll do it in colors. Let's see. I'm going to redo this. So I'll use red for investment and income. So, no, you know what? Yeah, maybe I'll use red for income. And blue for investment. And I'll use black for present value tax shield. So far we have, for investment, we have 40,000, and we have the sale. For income, we don't have anything yet. Okay, so let's continue. According to makers, the firm can depreciate the investment using 7-year depreciation. Okay, so this is about depreciation. So that will be the tax shield piece, right? For 7-year schedule. And the firm is in the 40% tax bracket. The price of your product will be $300 per unit. So that's part of income. And will remain constant for the duration of the project. Labor costs will be $12. Where does that go? Income, investment, or tax shield? This will be an expense, so this will go in income. And it will increase by 1% per year, so that goes with this as well. Energy costs will be $5.15 per unit, and they will increase by 3, so that's also part of income because that's an expense. Operating cost. Revenues are received and costs are paid at the end of the year. The required rate of return is 10%, and these are the units of output sold. And units of input. So lots of red, that's lots of income elements. The tax shield for the depreciation I put in black here. Okay, so it's more red. This problem has more to deal with income. There's no net present value here. So note, what am I saying? There's not net present value. I meant to say there's no net working capital required. That's been left out. So let's put this together. So why 12,000 is investment? It's 12,000 is we put it in investment because that's where we put it. I know you think of it as income, but the idea is that the treatment, the way we're going to deal with it is different than the income. In income, we get the net operating cash flows, and then we calculate their amounts after taxation. We deal with taxation differently in these two regards, right? We are going to invest the 40,000. Anyway, when we get there, you'll see. We'll deal with that. So these get treated different. Investment elements get treated different than the items in the income. Revenue minus expenses. Okay, so what happens? So here I've made a table with all the amounts following the instructions, with revenues, labor costs, energy costs, net revenue, and after-tax revenue. So I've done it all in a table. That's one way to do this, and you get this amount. But I went step by step below and computed using the information. In the first case, you're told that the revenues after tax will be for these amounts of units. In the first year, it's 100 sold, 200 sold in the second, 200 in the third, and 150 in the fourth. And each item is worth $300, and then you have to compute, you have to pay taxes on that. So that's the after-tax amount. So this is the revenue amount here. In terms of expenses, you have both. Remember, let's take out this information here. You have all this information. Okay. Oh dear, dear, dear. So this is the information. I just erased the whole thing. Oh no, that wasn't what I wanted to do. I just wanted to erase. No, it won't let me. Okay, sorry, this is so messy and confusing. Hold on. I'm going back. All right. So what we have to do is get the so we have that, the per unit cost, but now, sorry, the per unit sold. Now it's $12 labor costs at 1% increasing, and energy costs $5.15 per unit, 3%. And these are the units. So these are the labor units. So we have to put these numbers together with these numbers. And that's what's here. So what you have here is 4 years. 4 years of a growing at 1% annuity. Notice that the labor costs are the same. So it's 2,000 units. So 2,000 units at $12 a unit with a growing annuity after tax. That's what that is. And then you add the energy cost. That's also an annuity. As an annuity with, there's 200 units of energy cost, you see? The same. And there's 200 units at $5.15 each in a growing annuity after tax. So that's that portion. So what we have here, what I've given you here with a negative in front, is these two rows as the present value. So I've done them. You can do it as a table if you like that, more accounting, or you can do it as annuities. So this is the result. And when you put it together, you put the revenues minus the expenses and you get the same answer. Okay, I'm going to take just a little break. I have to check something. I want you to look at what happens with investment, and I'll be right back. Look at what happens with investment. Okay, you ready for investment? So, notice, we have to separate investment from income because of the way we deal with taxes. Notice on the $40,000 spent as the initial investment, I do not include an amount after tax, you see? I use the entire amount as negative, as an outflow, cash outflow. You get that? So it's not like an expense, as this would be an expense here, where I consider after-tax expenses, after-tax income. What I do instead is I have the privilege of expensing depreciation over time. That's how the tax system deals with it. So here's my table with my rates from 7 years. I should be familiar with these now. And this is my table. Remember, calculating depreciation is just 40,000 times the rate. And then this reduces the cost of capital, the value of the capital, equipment. And then it goes over to the next year. And the next year, I get to depreciate more because in the first year, I had the half-year rule. This was half of 28.6%. And then here, I compute the depreciation and I remove it from the value of capital. So on my books, this goes down, declines down to 12,480. This is the book value. And I need that to compare against the salvage value. Now, in class, they were the same amount. The book and the salvage value were the same. But here, the residual value is different. If you read the case, if you go back and read what was in the exercise, you're going to sell it for $12,000. That's less than the book value. So as a result, you will get the $12,000 and then you get tax savings on the difference. So this expression is one that I showed you in the notes to help you compute the present value of the residual value. So this one takes place immediately. No, this all takes place, at year 4. Right? This is all going to take place at year 4, end of year 4. So just to remind you, I have this equation in the notes over here. So in this example that we covered in the class, the salvage and the book value were the same, so this would just have been 0. So we only included the salvage value. But in this example that we're looking at right now, they're different and it reports a loss. As a loss, where the book value exceeds the salvage value, that means we can claim a loss in taxes, and as a result, we will get tax savings. We'll experience tax savings. So back to the problem. That's what I calculate here. All right, so that's why salvage goes separately into investment and is not included in income because it gets a different tax treatment. We have other considerations. It's not just blanket. You don't just go across computing after tax, net operating cash flows. How does that sound? All right. So, what we have to do next is, put this together. This amount is discounted by 4 years minus the initial investment. So this is the effect of investment. And finally, we have computed here in the last column the tax rate times the depreciated value all the way down. And that gives us the tax shields. So we're going to add those in right here. Okay. And then you put it all together. You combine income, investment, and present value of depreciation tax shield. This should be 2. To compute the NPV of the project, and you find that the project is a positive NPV project. Any questions? Okay, no comments? You guys okay? Please talk to me. I don't know where to go. I don't know what to do. Just keep finding problems for you. Let's try this one. Number 4. How do you find 2,288? Where is that number? 2,000, where, here? I'm not sure where you're looking. I know when the salvage value equals, the book value, how do you report? Oh, okay. So when when the salvage equals a book value, when the salvage value equals a book value, how do we report the sale price? You just have to be sure to claim this amount when they're the same. There's just no effect. There's no consideration. You don't have to report a loss, and you don't have to report a capital gain. Okay? I'm not sure if I answered your question. You asked me two questions I don't know how to answer. How do you find 2,288? I don't know where that number is. 2,288. In this problem or a different one? So if they're equal, you just can put 0 here. You know, you just make it 0. And the sale price will be here. So you'll get the sale price and you discount it 4 periods in this case. All right. Shall I do this other one, number 4? This is document 20, still document 20.5. So in this exercise, your company has been considering introducing a 4-year-long computer hardware system to its ongoing operations. You can acquire a networked computer system which would cost $100,000 and require ongoing maintenance costs of $30,000 per year. It is expected that the computer hardware components could be sold for $20,000 in 4 years. You adopt a 7-year schedule to depreciate the hardware. All right, so these are the networking capital requirements. I've already conducted a calculation of summing them. So this is called networking capital required. And if we stick with my coding system, investment is blue. Okay, so this would be part of investment. So this is networking capital, oops. This is net working capital, current assets minus current liabilities required. And then I have to calculate the net working capital changes. The way that I calculate that is taking this amount. Initially, I'll need this amount, right? And then, let me move this down. In the subsequent year, I'll need 2,300 more because I need a total of 11,200 for year 1. So 11,200 minus 8,900 leaves 2,300. In the next year, I need still a little bit more, 400. So 11,600 minus 11,200 leaves 400. In the next year, I have 9,600, so that's less. So now I release funds, right? This is going to release funds in the project back to the firm. So this is 2,000 less. Finally, the project closes, the project ends, and all the funds are released back to the other operations of the firm. And 0 minus this amount, this is a negative. And finally, I convert those to investment cash flows, net working capital investment cash flows, by changing the sign. From the firm perspective, we need this amount up front. So this is an outflow, cash outflow, so it's a negative. Similarly here, it's a negative, but then the funds are returned to the firm, so this is a cash inflow, it's a positive. And so the same here. So those are going to go into my project valuation. Then you're told here that revenues accruing directly from this project are anticipated to be $30,000. This is income per year. Other companies will be expected to increase business with your firm with anticipated net revenue. So this is also revenue, but what's the name of this kind of revenue? What do we call that? So what do we call this? Other companies, it says other companies will be expected to increase business with your firm with additional anticipated net revenues of around $5,000 per year indefinitely. This is an increase in revenue as a result of the project, so it has a special name. It's called a side effect. A side effect of the project. Finally, based on quantitative analysis of cash flows, determine whether the system should be purchased if the required rate of return is 10% and the corporate tax rate is 40%. So, all we have for this project is this mention of revenues. We have for investment, we have this net working capital requirements, and then up here we have the cost of so your company has been considering introducing a 4-year-long computer hardware system to its ongoing operations. You can acquire a network computer system which would cost $100,000. So this also is blue for investment. But then there's maintenance costs. These would be red for expenses or income. This is an expense that goes into income. It is expected that the computer hardware components could be sold for $20,000, and that is part of investment. That's the salvage. Okay, so the blue goes into investment and the red goes into income, and then the tax shields will come out of the investment table, the depreciation table. So here I've created the depreciation table for $100,000 purchase. You compute all the depreciation amounts. This is the amount you can claim and deduct taxes as an expense over time. And as you work through the UCC, you find the book value at the end here. And this book value needs to be compared to the salvage value. You were told that you could sell this $100,000 equipment in 4 years for $20,000. So $20,000 you can sell it for. In the books, it's worth $31,200. So again, that's a loss. That's a capital loss, which you can claim in taxes and get realized tax savings. Questions? So we put everything together in these calculations here. Now you may have done a table. I prefer to do it this way. We have all these formula to help us. Here is, I have the total at the top, but here are the steps of what was included. So we included this is the maintenance cost, and this is the revenues. So the maintenance cost and the revenues cancel. No matter what I do here about, it's an annuity and there's an after-tax amount, that's irrelevant. This was the revenue and this was the maintenance cost. Let's go back and look at that again. So you see, here's the revenue down here and here's the maintenance cost. They cancel. They both go into income and create zero. However, there's a side effect of the business, and the side effect of the business is enough to give us a positive income. What was the side effect again? Let's go back. The side effect says that other companies will be, make it bigger. Other companies will be expected to increase business with your firm with additional anticipated net revenues of $5,000 per year. So there's a reputation effect of conducting this project that actually creates positive income for you. All right. So in terms of present value of future cash flows, this makes our income portion $30,000. Questions? Okay, let's see. Where do you find that amount in the book value? Let's see. I'm sorry. Okay, so if this amount is something else. These are the tax shields here. These are the tax shields. I didn't even talk about them yet, okay? Oh, it should be in black. I said I would do black tax shields in black. Okay. So the way you calculate that is using this formula. 0.4 times the amount here. That's what it is. that okay? So Louis Charles, you were asking me about the other one too, right? So that's the same thing. Yeah, you were asking for this. I wasn't sure what you were asking. So in this first example, it's the same thing. This is equal to well, what was it in this problem? It was a tax rate of 0.4. So 0.4 times 5720. I just use this D, you see? All right, now you know. All right, so everything's okay. So what did we do here? So I did the income. Now investment. Investment includes net working capital investment cash flows. And then this. This is the salvage. Sorry, let's start over. The initial investment. So keep up with me. These are the net working capital cash flows as a present value. And then I took the salvage and the book value minus the salvage. So we sold at a loss, so this is increase, right? It's plus. And so that's because there'll be tax savings as a result of declaring or claiming a loss in the sale of your capital equipment. And then discounting for periods, you get that. So those three amounts need to be combined to get this. So in terms of investment, it's much more negative, right, than the income. Income was 30,000. So what remains is to check the tax savings from being able to expense the equipment over time. Is that enough to offset the investment expense? We need to check. So let's take the last items in the last column and see if you discount these. Even if you just look at them now, it's not enough, right? This is about 20, 30, it's the most 30,000, so it's not enough to offset this difference. So when you put it together, the tax shields only amount to 21,000. So in the end, it's a negative NPV project, so you shouldn't pursue it. How are we doing? Is that it? It's 6:30. It's 6:30 and I've done a few exercises. I hope you see the pattern. Tell me if you see the pattern now. You see the steps. Let me know if this is good. I think Anouk was asking me for steps. Somebody was asking me, no, Francette, I don't know who was asking me for steps, but that's the idea. 1, 2, 3, income, investment, and tax shield. You need to make these tables, at least this table with your investment. And if you have net working capital, you have to make this table. Some students who are maybe comfortable with accounting might want to make everything in tables in their income. And that's okay with me. Just make sure you let me know what you're doing because it's hard to follow and hard to grade otherwise. All right, so 6:36. Let's take 5 minutes, and when we come back, we should cover the new material. Unless you have questions. Okay, so let's take a 5-minute break. I need to get some water. And you can tell me if you have questions. I know it's a lot of material, but you have me at your disposal, so please ask me to help focus you on what you need to do. All right, I am back. Okay, so some of you've written me, you're confused, don't know what to do. I can't, it's just a matter of examples. You have to sit, you have to try these exercises, review the videos. I don't know what else to tell you. You have to identify, in the case, what are elements of income, what's investment, and what's, once we get investment, we can find the tax shields. Natalie is asking, I'm not sure what I can do. You just need to sit, Natalie, and review these videos, okay? You sit and watch what I'm doing, but essentially, you have to read the case, you have to separate elements of income, which is revenues and expenses, and you have to separate that from investment. Investment is any equipment that was acquired, building, a purchase that was made for the project that you will expense for tax purposes, and that will be separated from the income component. And then using this model, this table of depreciation, these are just taken from the table that I gave you called the maker's table, and you just follow along here. You multiply each amount, each rate, depreciation rate, by the initial investment, and you get these amounts. Now with these amounts, you go one at a time. You need to determine what remains of the asset after depreciation. Depreciation is the wear and tear of the equipment over time, and for tax purposes, you're allowed to depreciate at a steady rate. In the first year, you can claim $5,720 loss in taxes. So as a result, the value of the asset on your books has gone down. So you subtract from the $40,000 asset, you subtract the depreciation, and that remains here. So then in the next year, you compute the depreciation using this rate times 40,000 again, and you get 9,800. This is 9,800 that is going to be claimed on your taxes that year. Depreciation is not a cash flow. However, if I just keep on going, I can determine what the book value is. So I take this amount away from what remains of the asset, and I end up with this amount. And I repeat that until here. This is when the project ends, fourth year. In the fourth year, this is the value of the capital equipment in the books. So this is my equipment. This is what it's worth. And that's what I will use to compare against the sale price. The sale price was $12,000. It's worth $12,400. As a result, $480 is a loss. I get to claim that on my taxes, and as a result, I'm going to experience this tax savings. So everything that happens in taxes, it's not here, it's just the result that I care about. I care about the result, the effect of depreciating the asset and leaving this on the books. And I also care about using the depreciated amounts to calculate the tax shields. For the tax shields, this is over each year. This indicates how much tax savings there will be. So I've already derived these formula in the first class when I talked about this. This is the approach you use, TC times D, to find the tax savings. You just take the amount that you're going to claim on your taxes, the D, and multiply by the tax rate. So in the first year, you're going to save $2,288. In the second year, $3,920. Now what you have to do is you have to discount them as we learn because of the time value of money. So I don't know. Natalie, I'm just doing examples. These are just examples of the first session. I haven't done anything new here. So you need to sit and review the videos, solving the problems as you go. Okay, it's the same. I've just done the same thing. So I gave you some more exercises. One more, I think. Actually, wait, let me go back to that. Is there any more here? There's more pages. So you need to work independently, or as a group. Here's my other case I gave you and all the solution. This is a long one. Okay, this is a long one. Then I gave you an assignment that's due on Sunday, and there's only one capital budgeting exercise. So you need to follow the format of the ones I've given you and apply it to the one I gave you as an assignment. So you just have to work on it. If you want my help, I can help you, but you have to try. You have to sit and read the case and separate the elements of the case and then recombine them. All right. Any other questions? Yes, Natalie, they are the same thing. Same material. Okay? Same material. So what I need you to remind me, because what we're going to do next, unless you have any questions for me, what we are going to do next is essentially applied statistics. And I don't know how much statistics I need to review with you because you just took statistics, right? It should be fresh in your mind. All right. All right, so I'm a little bit torn. What I'm going to do is I'm going to start the new material. I'm just going to ask you, did we do this together? Did we do this together? Did we discuss scatter plots together? I cannot remember. Do you remember? Sorry, I mean, I can't remember and I'm expecting you to remember, but do you remember discussing scatter plots with me? Did I teach you regression or did Aspilera teach you regression? Who remembers? Okay, so I did. So this should be fresh in your mind then. Great. It should be fresh in your mind. One thing that needs to be fresh in your mind is the calculation of a standard deviation. Okay? That, and actually you can go, you can go to my site to check. Remember, I have the videos in my stats YouTube that you can see if you need to re-see this. But this was the discussion here of calculating the sample standard deviation and where this formula comes from. So I need you to be able to recognize this formula. Remembering that we use the mean and standard deviation as measures of expected value and the average deviations from the mean. This is the expected value and this is the average deviation from the expected value, really. And what we do with them is interpret. This is the mean, this is the standard deviation, and what we do is we say this data was regarding a student's pocket money over the week. So we summarized using two measures, the mean and the standard deviation, and we said she spends about $8, or she has to spend $8.20 in her pocket, give or take $5.31. And I taught you that you take $8.20 and add and subtract $5.31. And most of the observations are in that interval. Correct? And you guys remember that? Now this is how you work with what I refer to as historical data. So every observation here has equal weight and significance. And I taught you how to get these results out of your calculator, right? I discussed using your calculator to find these results. So let's review that. Review that, in the calculator. So 2, 8, 10, 16, and 5. Remember to refresh your feed if you can't see things clearly. So let's see, for 2, 8, 10, 16, 5. So we go to the calculator. And now we're going to use stat mode of the calculator, remember? So we enter second data, and it should be empty. All right, now we want to put the numbers in. Two, 8, 10, 16, 5, right? So 2, enter down, and we skip over y. Then we put in 8, enter, down, down, and then 10, enter, down, down, then 16, enter, down, down, and 5, enter, down, down. And then you ask for second stat, and you get the linear results, LIN for linear. So you remember, we scroll down, n is equal to 5 observations, 8.2 is the mean, and SX is $5.31. So now you know how to get it from your calculator. We only use one variable, so that's all the information we have, except for this one. Remember, this is the standard deviation of the population, but we are not interpreting that. We interpret the sample result, the S. And then we don't have anything else because we only had one variable, so nothing else means anything there. So that's how we deal with one variable at a time. And we can find most of the observations in this interval if we add and subtract. We find 60% of the observations fall in there. So that's what we mean by most. Now what if data didn't come like this as historical data, but instead appeared as what we call ex-ante data? Ex-ante data looks like this, where you have different states of the world. These are the possibilities. These are the probability they will occur. And I ask you, what's the expected value of this distribution? That's what this is. This is actually a distribution. And as a distribution, and this was derived from taking possibly information, historical data on this variable. And in this case, again, we use pocket money. So we've observed pocket money over several weeks, and then we consider the coming months and the state of the economy and stability of this person's income. So we use all this information together to create a distribution, and this is a discrete distribution. So this is a review, right? This is a review. And if you didn't learn it before, now you're going to learn it. It's discrete because there's only 5 possibilities, and these are their probabilities. So to calculate the mean and standard deviation here would be, it's not possible right away. It's not immediately possible to get these values out of your TI BA2 plus calculator. Different calculators can calculate data like this to find mean and standard deviation, but I would recommend use Excel to do this. So you can use Excel to do this. Would you like me to show you? Or are you okay? Let me know. I'll wait to hear from you. Okay, so let's do this together in Excel. I was just checking. How's the feed? I'm just checking the feed. Okay. All right, so let's do this in Excel. I didn't do this. I must have done this with you in class, no? Maybe not. So I'm just checking the videos from before. I'm just thinking to refer you to the old videos because then it'll jog your memory. Maybe I didn't do it. Okay, so let me show you. Oh, I just took a screenshot of my screen. Uh-oh. Okay, let's go to Excel. Now in Excel, we want to put X, and you want to put P, the probability. I'm going to cheat on the subscripts because they're not easy for me to figure out how to put them. So let's put the data here. It's 2, 8, 10, 16, 5. 2, 8, 10, 16, and 5. And then the probabilities are 0.2, 0.3, 0.1. Point 3 and 0.1. And so what you want to do first is calculate the expected value, right? The expected value, or the average, is a result of multiplying x times the probability. It looks weird, doesn't it? Let me put a... Nope, doesn't want me to do what I want to do. So this is just, you have to pre-multiply every value. So I'm going to multiply D and E, right? D times E. So this becomes 0.4. This becomes, well, let's make a formula. This equals this times this. And then I'm going to copy that formula down. Nope, that didn't work. Do it again. Equals here times here. And then this is equal to 8 times 3. And this is true all the way down. And I don't know why that continues to be like that. Okay, so now I've done the probability, I've done the observation, or the value, times its probability, and I put it here. And now I just have to sum all the way down. And there it is. So this is the expected value. This is x bar, like mu. We call it mu because this is this represents a distribution. So that's the mu. Okay, and then what we want to do with that is we want to calculate the deviations from the mean. So the deviations from the mean are going to be the value minus the mean. And what we have to do is square it every time, because we have to square it every time because of the reason that we discussed before. If we were to find the average of the deviations alone, the average would be 0, because the sum of the deviations will be 0. So then this will equal, you have to go over here and subtract off 9.1, and then you have to copy that all the way down. And, oh, I didn't square them. I have to do it again. So don't forget to square. Do that again, squared. And then copy that all the way down. And then, now that you have the deviations from the mean squared, you sum those. So this is just the sum. No. What you have to do next is you have to multiply them by p. So you have to take this amount and you have to multiply them by the probability. So are you with me what I did there? I'm going to put it in the front of the value because this looks very confusing. So I have to take the probability, which is this one, and multiply it by this one here. And I take that all the way down. So what we've done is, I think something went wrong. No, that's fine. So this is E times G, and now I can sum. And I'm not finished because I have to take the square root. So this is called the variance because it's before I take the square root. So when I take the square root, hopefully I get the right answer. I didn't make a mistake. And we get 5.14. That looks good. So I hope you follow this video and practice. I don't know why I wrote that. Standard deviation. Okay. So, did you follow? Questions? I'm going to copy this over so then I can relate it back to the notation I have in the notes. So I'm going to fit it in here. You see? So this replaces, I don't know if I can make it big enough. Do you see now? How's that? Questions? So take a moment to look at that. And notice, oh, I need to lock it together. Notice our numbers are similar, but I picked the values to accomplish this, achieve this task. But so what we do first, these are the values, these are the probabilities, and I did this online. There were videos for computing this among my videos, but this is using Excel, so can be much faster, I think. What do I have here? Okay, I don't actually have this column. Let's erase this column. I just squared them right away. So what we have here is, this is, oops, I don't want to do that. This is this, and this is this. And then the formula says, take these, which is this one, add them up, and then take the square root. So this is the sum down here. And then this is the square root of the sum, which is called the standard deviation. All right, so that might make your life easier. How's that? Give me some feedback. Okay. All right, so what did we do here? So I just reminded you there's two different, so let's look at the big picture. There are two different types of data sets. There's a historical data set where you get values and they all have equal weight, and you just use these formulas here for mean and sample standard deviation. And when you have what we call ex ante data, I call it ex ante data, before the fact data, you get probabilities along with the outcomes, and you calculate slightly different, looks similar, but it's slightly differently. So you guys can practice with that. I'll give you some exercises to practice. So you need to remember that, okay? So historical and ex ante data. Now, what do you remember about two? You remember about two variables. We had this discussion about two variables and correlation. Remember the correlation coefficient, which is really important, and deriving the correlation coefficient. So you can go back to that if you need to remember, but right now I'm going to take us to, let's open document. Let's open this document here. All right. So here are two data sets. Now I did give you this data, same data in statistics, but I don't know that we went through it together. So let's look at it together. Here are two variables, and this is finance. This is correlation for finance. And in finance, we put the market returns on the x-axis, the horizontal axis, and we put stock returns on the y-axis. So what we're going to do right now is we are going to visualize these two together. The market index is like something like the S&P 500. There is an algorithm that tracks the prices of the top 500 performing companies and that issue stock, and they tabulate, they combine their market capitalization, that is the outstanding value of their stock, and they put them together in an index that represents, this is meant to represent market performance. So the higher the index, or from one period to the next, the better the market performs, right? So S&P 500, Dow Jones Industrial Average in the States. Okay. In Canada, it's the TSX or TSE. In Toronto. Okay, so that's what this would be, the market. So it looks like the market returns 15% when, in period one, this company, this is Bell Canada Enterprise, they return 30%. Now, what do these returns mean? We're going to talk about that in a moment. But what I first want to do is bring in the tool you have to look at correlation. All right. So you already have those tools from statistics. Let's use them. So looking at these, what is the relationship between these returns? How are they related? How are they correlated? Aha, very good. Very good, very good. Double. Okay, so what does that mean, double? If I was to make a scatter plot with X here and Y here, so then always put the market returns on this axis. So actually I'm going to call this market. And I'm going to refer to this as BCE, okay? So this is some stock. I'll just call it stock. And these are their returns. If this is double, what would their scatter plot look like? Can someone tell me? Can you plot it? Okay, so Jeffson has written for us that the market is equal to BCE. Are you sure? Close. Other way around. BCE is 2 times market. The first one. Oh, Innover. Not exactly 45 degrees. Okay, so let's do this. Let's pause on the drawing and let's go to the calculator. So let's put these in our calculator. Ready? Get your calculator ready. What happened just now? That's so funny that it did that. We're going to open the calculator. And let's enter these values. Now we have pairs of data. Let's hit second data and clear the worksheet. So second clear work. So now it's empty. Can you see my calculator? Ready? So I'm going to enter 15, enter, down. And then the other pair of 30, enter, down. Oh, that didn't work because yeah, that worked. So I have 15 and 30. Now let's continue. The next pair, 9, enter, down, and 18, enter, down. Any questions? Are you okay for this? Let's keep going. 10, enter, down, and 20, enter, down. Then 7.5, enter, down, and 15, enter, down. And then 8%, 8, enter, down, and 16. All right, so I've got to check my numbers. So it was 15 times 2 is 30, so that's good. And then 9 times 2 is 18, was right. And then, did I miss one? 10, this is 10. 10, enter, down, and then y is 20. And 7.5 and 15. and 8 and 16. And there we go. So now I ask the calculator for the results of the linear regression. I hit second, stat, and here are the results. There are 5 observations. Here's the mean of the market returns, 9.9. Here's the standard deviations of the market returns, 3%. Here's the standard deviation of the population, but I ignore that. Now this is for Y, 19.8% for BCE, and the standard deviation of 6.01. Okay, so now I'm getting to the interesting. So yes, Jeffson or Inobert had the right. There's no intercept, A, and B, the slope is 2. So what is R? You guys tell me, what is R? So what is R? What is the correlation? What is the correlation? No, can punch it in your calculator. Do you have the calculator? Do you have the calculator? Do you need the calculator? Oh, no. I want to go here. Now look, listen to me for a moment. This relationship is 2 times and it's perfect. Every single observation is 2 times the market returns for BCE. Every single one. That makes it perfect. When it's perfect, it's perfect. When it's perfect, it is perfect. It goes like, it will start here, but it'll have a slope of 2, but be on a perfect line. Okay, so the slope is 2, but R is equal to 1. Perfect, positive correlation. So that's the difference between the slope and the correlation. Remember, correlation is the direction and strength. Direction and strength. Direction and strength of a linear relationship between quantitative variables. Having trouble in that corner. What's happening? There you go. That's what R is. And slope is just the trend. But it doesn't have to do the strength. It just has to do with the trend, the linear trend. Okay, so R is 1. Positive 1. So, I ask you to practice in this document. This is document 25.1. I ask you to practice making these calculations. For the mean of both. Now, as long as you can get them out of your calculator, that's great. But don't forget where they come from. That's the mean, the standard deviation of each, so you should practice. Okay, so what I want to say about this is remind you of the formula for slope. The slope is equal to, change in y over change in x. In our case, it's 2. But if the change in x was 10, this would be 20. It's a ratio relationship, right? It says that if there's a 1, in terms of our variable, if there's 1% increase in the market return, so let's say the market performs better next month or next quarter, if there's a 1% increase, then BCE, the y, will increase by 2%. And you see that that's really great here when things are positive. But what if there are negative returns? If there's negative returns, it's the same. If there's a negative, so negative 1% increase in the market means BCE, so negative 1 increase is really a decrease. So a decrease of 1% in the market implies 2% decrease in BCE returns. 10% decrease in the market means 20% decrease in BCE returns. So if this line is true, you could also see negative returns, which we don't like, right? But it could be true. So we say that this is a sensitive, BCE is sensitive to market returns. We refer to, remember the slope, I taught you that you can calculate it as R sy over sx, remember? And it spells risk, I told you. And that is for financial cases, the beta, the slope, reveals or exposes the sensitivity of BCE returns to market returns. And that relationship, now how do we include R now? That relationship is perfect. So it's a very reliable slope measure. Okay, we have a few minutes to go. All I want to do next before we go is I want to talk about, okay, so I put all the calculations in here. You can practice making all these calculations. What I want you to calculate, and I know tonight you'll be working on your assignment, but this is what I want you to be able to do. Mean, standard deviation of the BC returns and the market composite index. And then I want you to get also to compute the correlation coefficient. Remembering I told you The correlation coefficient, what is it? It's a calculation off of your calculator, but it's really the covariance of x with y standardized. It's the standardized covariance. R is in -1 to 1. The closer to 1, the more perfect the strength of the relationship. And the further from 1, so closer to 0, means no linear relationship. And finally, I want you to calculate the beta. I want you to practice. I mean, you have your calculator, like I said, but I want you to practice making these calculations because I'm going to do other things with these formulas. So it's good to practice. And I guess I can just show you the ex post one. There's the other one that is, ex ante, this one here. So this is the other way to see the data. I've given you 3 states of the world and asked you to do the same thing. Calculate the mean and standard deviation, expected return, the standard deviation, but when you have data that have 3 possibilities, these are the probabilities of the 3 states of the world. How do you calculate the mean, the standard deviation? You can do it with tables like I showed you to practice. And this is where we can start next class, and then we'll talk about interpreting it. This is not so straightforward on how to draw it because every observation has different significance and it's hard to visualize. So with that, I will sign off for the evening. If you have any questions, you let me know. But this is where I'll start next class, okay? Tomorrow afternoon at 1 o'clock. 1 o'clock. Let me know if you have any questions right now. I'll stay on. So just get to your assignment. Do you have any questions for me? Thank you, Francette. You guys can ask me more questions tomorrow. Some people were asking, the assignment will be due. Assignment 2. Is due Sunday at 11:59 p.m. So you can ask me questions if you have them. Okay, good night. Bonsoir.